After going through these videos on group accounting and consolidation, let's try a work example. On 30 June 2014, Alice Limited acquired 75% interest in Wonderland Limited, paying in cash. At the date of acquisition, Wonderland Limited's equity component in its statement of financial position was as follows. And here are the additional information pertaining to the Alice Limited group of company for the year ended 31st December 2019. And this is the statement of financial position as at 31st December 2019 for both companies. So we are required to prepare consolidation journal entries for the Alice Limited Group as at 31st December 2019. Please round off your figures to the nearest thousands. Next, we will prepare the consolidated balance sheet for the Alice Limited Group as at 31st December 2019. Let's start off with Part A first.
First, let's eliminate the investment in subsidiary account. We noted that Alice Limited acquired 75% of shares in Wonderland Limited, and this is Wonderland Limited's equity balance on the day of acquisition. We also noted from point I that at the day of acquisition, Wonderland Limited's equipment was undervalued by $250,000. The consolidation journal entry to eliminate the investment in subsidiary account is debit share capital, debit retained profits, debit revaluation reserve by 75% of the balance on acquisition day, debit equipment by 75% of the undervalued amount on acquisition day, credit investment in Wonderland Limited by its balance according to the balance sheet of Alice Limited, and debit goodwill by the remaining amount to make the debits equal credits. Please note that all figures here are in thousands of dollars as specified in the question. Moving on to point II, we noted that goodwill on consolidation was assessed for impairment and found to be impaired by 40% of cost in the current year. Just now, we recognized the goodwill of $563,000, so the amount of goodwill impaired is 40% of $563,000, $225,000. So the consolidation journal entry for this point is debit impairment loss on goodwill and credit accumulated impairment by $225,000. Before we do the consolidation journal entry for the remaining additional information, let's attribute equity to the non-controlling interest first. We noted in point VI that Wonderland Limited recorded a net profit after tax of $1,146,000. To attribute profits to the non-controlling interest, we debit non-controlling interest income statement and credit non-controlling interest balance sheet by $287,000, obtained by taking 25% multiplied by $1,146,000. Since Alice Limited owns 75% of shares in Wonderland Limited, the remaining 25% of shares is attributable to non-controlling interest. Before we attribute the remaining equity to non-controlling interest, we need to compute the beginning retained earnings, which is $5,005,000. We also noted in point I that Wonderland Limited's equipment was undervalued by $250,000, so we need to attribute that to non-controlling interest as well. We debit share capital, debit revaluation reserve by 25% of Wonderland Limited's current balance, debit retained profits by 25% of the beginning retained profits. Then we debit equipment by 25% of the undervalued amount and credit non-controlling interest. Continuing to point III, where Alice Limited sold goods to Wonderland Limited costing $129,000 at a 25% markup. Only 60% of the goods have been paid for and 50% of the goods have been sold to external parties by Wonderland Limited. First, we will eliminate the payable and receivable balances arising from the sale. The sales amount is $161,000. Since 60% of the goods have been paid, the trade payable and receivable balance should be 40% of the sales amount, $64,000 in other words. So we debit trade payables, credit trade receivables by $64,000. Second, we will eliminate the whole sales transaction, debit sales, credit cost of sales by $161,000. Third, revert the cost of inventories back to original cost. We noted that only 50% of the goods were sold to external parties, so the remaining 50% of inventories that is still with Wonderland Limited is carried at inflated cost. The amount of inventory that Wonderland Limited is still carrying is $81,000. The original cost of the inventory still in Wonderland Limited is $129,000 multiplied by 50%. So you realize the inventories are inflated by $16,000. To revert the cost of inventories back to the original cost, we debit cost of sales and credit inventory by $16,000. In point IV, Wonderland Limited sold goods for 107,000 to Alice Limited based on a markup cost of 20%. Note that 107,000 is the sales amount. 60% of the goods have been paid for, and Alice Limited sold 60% of the goods to third parties. First, we will eliminate the payable and receivable balance from this sale. If 60% of the goods have been paid for, the payable and receivable balance should be 40% of the sales amount. So we debit trade payables and credit trade receivables by 43,000. Second, we will eliminate the whole sales transaction. Debit sales, credit cost of sales by 107,000. Third, revert the cost of inventory back to the original cost. 60% of the inventories were sold to third parties, so the remaining 40% of inventories is still with Alice Limited. Alice Limited carries them at 43,000. The original cost of inventory is 107,000 divided by 120%, the markup amount, and multiplied by 40%. The inventory value needs to be decreased by 7,000, so we debit cost of sales and credit inventory by 7,000. This is an upstream transaction. These three journal entries have caused a net decrease in net profit by 7,000. If the subsidiary's profit decreased, non-controlling interest will have decreased as well, since a minority of profit is attributable to non-controlling interest. The decrease in profit attributable to non-controlling interest is 25% multiplied by 7,000. We will debit non-controlling interest balance sheet and credit non-controlling interest income statement by 2,000. Remember, follow the opposite. If the consolidation journal entry caused a decrease in profit, we want to increase profit by crediting non-controlling interest income statement. Point V. On 1st January 2018, Wonderland Limited sold a piece of equipment with a residual value of 25,000 to Alice Limited, on which Wonderland Limited makes a profit of 55,000. Wonderland Limited had originally purchased the equipment on 30 October 2017. The group's policy is to provide depreciation at 20% of historical costs. No depreciation is provided for less than 1 year's usage. This actually means Wonderland Limited did not depreciate the equipment at all. The time frame from 30 October 2017 to 1st January 2018 is less than 1 year, so the residual value of $25,000 is the cost at which Wonderland Limited purchased the equipment at. The consolidation journal entries involving a sale of non-current assets between two companies of the same group is to first eliminate the sale and revert the cost back to original amount. When Wonderland Limited makes a profit of 55,000, it means Alice Limited will carry the equipment at 55,000 higher than the original cost. So we debit retained profits and credit equipment by 55,000. We debit retained profits and not sale of equipment because the sale took place 1 year ago. Next, we want to adjust the depreciation charges. Alice Limited would have carried the equipment at $80,000 and it will charge 16,000 depreciation expense annually. The original depreciation amount, meaning the amount that Wonderland Limited will charge if it still owns the equipment, is 5,000. So you notice a difference of 11,000 depreciation charge between the two companies. To revert the depreciation expense and accumulated depreciation, we credit depreciation expense by 11,000 to adjust for current year depreciation, credit retained profits 11,000 to adjust for depreciation in 2018, and debit accumulated depreciation by 22,000. Let's do a quick check to ensure our journal entries are correct. Looking at the adjustments needed for the equipment, depreciation expense and accumulated depreciation, we realize the consolidation journal entries have made the correct amount of adjustments. One last thing to note, this is an upstream transaction where Wonderland Limited, the subsidiary company, sold something to Alice Limited, the holding company. The consolidation journal entries have affected profit and retained earnings, which is attributable to the non-controlling interest. So we need to adjust the non-controlling interest accordingly. When we debit retained profits by 55,000, then credit it by 11,000, this results in a net decrease of 44,000. The retained profits attributable to non-controlling interest will decrease by 11,000. When we credit depreciation expense by 11,000, it caused a net increase in profit by 11,000, so the profits attributable to non-controlling interest will increase by 3,000. To adjust the non-controlling interest, we debit non-controlling interest income statement by 3,000 to decrease the profit, since the non-controlling interest has an increase in share of profit. Credit retained profits by 11,000 to increase retained profit, since the retained profit attributable to non-controlling interest has decreased. Then we debit non-controlling interest balance sheet by the remaining amount.
Before we move on to do the consolidated balance sheet, Let's fill in this consolidated worksheet so that we can identify what is the group total. So we'll just put in whatever entries that we have entered earlier on. Retained profits is a pretty tricky one because you not only have to consider entries that touches retained profits, but also entries that touches incomes and expenses. We also have a new line item here, which is the non-controlling interest. And earlier on, we recognized initially this amount. Please remember to add only non-controlling interest balance sheet items. Non-controlling interest income statement, as the name implies, goes to the income statement. And when it comes to equipment, we not only add in items that touches the equipment account, but also items that touches the accumulated depreciation account, because this is the net figure for equipment. Then we have a goodwill figure here, where we initially recognize 563,000, and we also recognize an impairment loss of 225. Now let's just make sure the total debits is equal to the total credits before we move on. Yes, they are. So now we can calculate the consolidated total. And we'll achieve this figure where the total assets equal to the total liabilities plus equity. Now we can move on to do the consolidated balance sheet. For all items under the group, we will simply use the figures that is under the consolidated total in the consolidation worksheet. So for instance, bank balances will be this figure. Trade and other receivables, inventories, and for the subsidiary, it will be a blank figure because we have eliminated it off. For property, plant and equipment, let's include both the equipment and the freehold land. And for goodwill, we will put in the net figure, which is this plus the accumulated impairment. And for deferred tax asset, it will be the same. So we will achieve a total asset figure of 80,745. Moving on to equity, we'll just put in the figures accordingly. Now, these three will contribute to equity that is attributable to shareholders of the company. We also have the non-controlling interest, which we have included right here. So, the group's equity will comprise both equity that is attributable to shareholder of the company and to the non-controlling interest. So if we add these two, this is the total equity. And if we take the total liabilities plus the total equity, then we will get a figure that is the same as the total asset. So this is what it means when we present the non-controlling interest under equity, but separately from equity that is attributable to shareholders of the company. Now let's quickly run through the one on the company. So we will just use Alice Limited's figure for this. It should be pretty straightforward. So we will achieve a figure of 41,671, which is the same as the total asset.